In today's episode, we will not repeat a discussion about whether AI remains the market's main theme. Instead, we will focus on a more specific layer. As the AI rally continues to move forward, why is capital starting to concentrate on the chip manufacturing supply chain? This week's strong performance in semiconductors and upstream equipment stocks shows that the market is repricing a deeper logic. AI capital expenditure is gradually moving from platform companies into chip manufacturing, advanced packaging, and semiconductor equipment. In other words, the market is now paying attention not only to which companies own AI applications and cloud platforms, but also to whose orders these platform companies' investments will eventually become. As platform companies expand capital expenditure, they first confirm AI demand. Computing chips benefit first. Then capital will continue to look for manufacturing bottlenecks, including HBM, Wafer Foundry, advanced packaging, and equipment suppliers. After that, demand will spread to servers, networking, optical communication, as well as data center power, cooling, power grids, and engineering construction. So the core question of this video is, if the AI industry leads the market again, in what order will capital rotate? Within this supply chain, which stocks are worth watching closely? 1. The basic order of AI capital rotation. My view is that this rally is the result of AI capital expenditure moving upstream through the industry chain. Platform companies put future investment onto their balance sheets, while supply chain companies convert that investment into revenue, orders, and backlog. The reason the market is focused on the chip manufacturing chain is that it is closer to order realization and can better verify real demand through earnings reports. Following the order of capital transmission, this round of AI-related gains can be divided into 4 segments. The first segment is computing chips and AI accelerators. Representative stocks include NVDA, AMD, AVGO, and MRVL. This layer is closest to AI data center demand and has the highest market recognition, so capital usually pursues it first in the early stage of a rally. This week's market action has already shown that computing power remains the most sensitive direction in AI trading. The second segment is HBM, Wafer Foundry, advanced packaging, and semiconductor equipment. Representative stocks include MU, TSM, AMAT, ASML, LRCX, KLAC, and AMKR. After AI chip demand expands, the manufacturing side becomes a new area to watch. The core of this segment is not short-term sentiment, but the capacity cycle and supply bottlenecks. The third segment is servers, networking, and data center interconnect. Representative stocks include Dell, SMCI, HPE, and ANET. Complete servers, racks, switches, routers, optical communication, and high-speed networks form the middle layer that moves AI computing power from chips into actual deployment. Orders for networking equipment often reflect the real progress of AI infrastructure construction. The fourth segment is physical infrastructure. Representative stocks include VRT, ETN, GEV, PWR, CAT, CEG, and VST. As the scale of AI data centers expands, the importance of power access, cooling systems, transformers, UPS, backup power generation, and engineering construction will continue to rise. This direction will become a very important later stage extension once the AI data center construction cycle lengthens. Based on the current market, today we will focus on the second segment, HBM, Wafer Foundry, advanced packaging, and semiconductor equipment. This segment absorbs upstream demand after computing chips and represents AI capital moving further toward manufacturing. Based on the current market, today we will focus on the second segment, where there are 5 representative stocks. 1. Micron Technology, HBM leader, deep pullback from historical highs. Micron Technology has the largest pullback among the 7 stocks, with a decline of more than 30%, making it a typical deep technical correction. In the short term, it may build a base in the $750 to $900 range. If it can hold firmly above $850, it may gradually recover toward $950 to $1,000. If it breaks below $750, it may move further lower. Trading plan, existing holders. The $850 to $870 range can be considered for adding shares to reduce the average cost, while around $930 is a short-term trimming area. New positions. The $750 to $850 range is a reasonable area for medium to long-term staggered entry. Stop loss reference. A decisive break below $700 requires reassessment. 2. AMAT. A typical representative of this round of AI capital moving further upstream. If memory manufacturers want to expand HBM capacity, they must first buy AMAT's equipment. After short-term consolidation in the $535 to $550 range, it may continue to test $600 or even higher. The August 13th earnings report is a key catalyst. Trading plan. Existing holders. Partial profit taking can be considered at $550 to $560. A pullback to $510 to $520 near the pivot point can be used for adding positions. New positions. Wait for a pullback to the $510 to $520 range before entering. Chasing at high levels carries higher risk. Stop loss reference. A decisive break below $470 requires caution. 3. ASML. ASML previously went through several months of consolidation and has recently broken out of the compression phase of an ascending triangle, entering a high volatility markup trend. The oversold technical indicator, stochastic 14.07, suggests that short-term rebound momentum is building. The short-term target is the $1,765 to $1,808 range. If it can break above $1,808 on strong volume, it may test $1,900 or even higher. Pullback support is near $1,686. Trading plan. Existing holders. Around $1,808 is short-term resistance and can be used for partial profit taking. Add after a breakout. New positions. The $1,686 to $1,700 range is a better entry area. Stop loss reference. A decisive break below $1,642 requires caution. 4. Lam Research. Etching equipment leader, remarkable year-to-date gain. LRCX has the strongest technical setup among the 7 stocks. Its price is above both the 50-day and 200-day moving averages. The most recent 3 bearish candles only reflect profit-taking by bulls and have not damaged the trend. After short-term consolidation in the $306 to $320 range, it may continue moving toward $350 to $370. If it can break above $320, greater upside could open. Trading plan. Existing holders. Partial profit taking can be considered around $320, while a pullback to $306 to $308 can be used for adding positions. New positions. Wait for a pullback to the $300 to $306 range before entering. Stop loss reference. A decisive break below $290 requires reassessment. 5. Amkor Technology, advanced packaging leader. Amkor Technology has the strongest long-term technical structure among the 7 stocks. After short-term consolidation in the $53 to $56 range, it may move towards $61 to $70. Trading plan. Existing holders. Around $61 is an important resistance level and can be used for partial profit taking. After a breakout, add positions and look towards $70 to $75. New positions. The $53 to $55 range is a better entry area. Stop loss reference. A decisive break below $50 requires reassessment. In the current market, the order of gains among popular stocks is moving from platform entry points to computing chips, then to manufacturing bottlenecks, server networks, and physical infrastructure. The company positioned at a key node in this chain, the one that can convert AI capital expenditure into orders and cash flow, will be the one more likely to receive a market premium at this stage.